So continuing going over investments, now that we tackled from a couple different angles, I wanted to review a little bit, and we're going to continue with questions after this. So in the financial statements, under the investment sections, we have bonds, notes, common stock, or preferred stock. And what we're doing in this chapter, we're understanding how to record these investments on the balance sheet, and we're trying to understand what kind of income they throw off. So for bonds, it's interest, notes is interest, common stock is dividends or realized or unrealized gain, preferred stock, it's dividends and realized and unrealized gain. So for debt security, we talked about just getting familiar with when does it mature, how much does it pay, and what does it get recorded at the beginning. We looked at this question before. When you first record it, Masterware issued a bond, and this is what it is valued. And how do you get these present values? You could do that in Excel or a financial calculator, or it's given to you. And that present value is what's recorded on the balance sheet, right? What's recorded as an investment. So when somebody purchases this investment, it's called an investment in bonds. It's $700,000, and they only paid $633 for it. The rest is recorded in discount, and we have the calculation backed up for this. And then you record the interest again. You have interest revenue, and then cash, and the discount on bond investment is the difference. And then when we look over at this, basically what you have to know with the discount, you also have to know where the discount is at the different periods. So this is given that we're gonna, as accountants, we're gonna continue making these entries every year. You know, so this is entry 1, entry 2, and so on and so forth. We need to know these balances, right? We need to know that this is the amortized cost at which period. We need to know that this is the discount at which period. And because these two stay on the balance sheet, right? This goes on the balance sheet, and the other one goes on the income statement, right? So here we are on the balance sheet, and we need to know how that unfolds. And this is on the income statement, right? This is relating to the income statement. And this is, keep in mind, this is all for the investor. So, right. So now going through, we have, again, 3 classifications of debt investment. We have the held to maturity, unrealized does not get recognized, trading, recognized in net income, available for sale, recognized in OCI. And these are the key differences. And this is oftentimes on the CPA exam, so definitely need to memorize it. We looked at the held to maturity, but for example, if a held to maturity investment, it doesn't recognize unrealized gain and losses. So when Wall Street Journal indicates that the fair value Masterware bonds on 12/31/2018 is $714,943, how will United account for this increase in fair value, right? So it will be ignored because it's viewed as temporary, and United will disclose the fair value in a note. So this will get disclosed in the note to the financial statements. There's still a disclosure comes, but in notes. But say on July 18th, Masterware bonds, date July 1, and the bonds mature in 3 years. Due to unforeseen circumstances, the company decided to sell its debt for $725 on January 15, 2019. So on January 15, 2019, we would check where is our discount, right? Where is our discount residing? What do we have in the discount? Okay, and 33 minus 464. Okay, so given that when did they sell it? January 15th, 2019. So it's actually right here that they're going to sell it. So the discount is still at 28,703. Okay, so that's why we debit that out. We receive cash of 725. We zero out the investment of 700,000, and we we zero out the discount, the balancing entry is the gain. So this is where you really have to look at it. You understand this topic, because why do we know that we get the cash for 725? Well, they're telling us that we got the cash. How do we know that we need to credit the investment in 700,000? Well, we know the original entry was for the investment was 700,000. That was the face value, so we have to credit that out. And the other piece that is missing is we have to know what the discount is in order to zero that out. So that's 28,703, and we need to debit it because originally that was the credit balance, right? Originally that was a credit balance that we had, and that's how we know that it would be a gain of 53,703, because that is the balancing entry. And we'll continue with more of this in the next slide as well, next video.